The government is considering revisiting the development finance institution model DFI to support the infra sectors that need rupees 100 lakh crore investment in the next 5 years. The earlier DFIs, ICICI, IDBI and IDFC have all converted into commercial banks, largely lending to retail assets. The banking sector did support infrastructure sector in the last decade, but the recent mismatches in the asset and liabilities and also the higher NPAs have forced the banks to withdraw from long-term lending. Why setting up a new DFI when there are two government-backed platforms supporting the sectors like the National Investment and Infrastructure Fund (NIIF) and the India Infrastructure Finance Corporation Limited (IIFCL)? Let us look at the structure, performance and limitation of existing infra financing platforms and also the blueprint for a new DFI. 5 years ago, NIIF was created as a quasi-sovereign wealth fund. It is like an alternative investment fund owned 49% by the government, while the remaining shareholding is with banks and international investors. Scale is a big issue for NIIF, which has mobilized close to $4.5 billion funds in the last 5 years. The focus, however, is on select sectors like transportation and energy. It also invests in funds managed by other funds and also has a priority equity model. IIFCL, on the other hand, is a 15-year-old non-deposit taking NBFC which is wholly owned by the government. The scale is clearly missing as it has a loan book of rupees 1.5 lakh crore with 1/4 of its book neck deep in NPAs. A new generation private bank like HDFC Bank has built a loan book of over 10 lakh crore in the last 2 decades. The loan exposure of IIFCL is also concentrated in two sectors, power and roads, with over 80% of their outstanding locked in these two sectors. There is a high dependence on government for equity support. There are also moves to give DFI status to IIFCL. This could be one of the proposals instead of setting up a new institution. Now let's look at the building blocks for a new DFI. Long-term funds with lower cost is at the core of the DFI to survive, scale up the institution to size and also create national assets at a lesser cost. The DFIs should be allowed to raise long-term fixed deposit from HNIs with a higher threshold like rupees 10 crore to 25 crores. The RBI should also pitch in with long-term funds either through long-term repo rate or investing its surplus foreign exchange reserve in these institutions. There should be a sovereign guarantee to get funds from global institutions or raise resources through rupee denominated bonds globally. The government should also provide a concession by allowing bonds issued by DFI as SLR investments by bank, which would encourage investment from the banking sector. Finally, the low interest rate scenario globally should be used to borrow long-term funds with appropriate hedging mechanism. The new DFI also needs risk mitigation strategies because of credit concentration in few sectors, which would put institutions at risk in view of any adverse event. This is something like what happened in the case of IDFC. In the past, the cancellation of 2G licenses and coal mines impacted the telecom and the power sector. The bulk of the lending by banks and also IDFC as a DFI was to these two sectors, which brought down the profitability of these institutions. The strategies could be a balanced portfolio in half a dozen subsegments of infra sector and also geographical diversification. The DFI blueprint should focus on effective monitoring, knowledge-based IT system and use of digital to monitor the sectors as well as borrower in a more rigorous manner. The long-term lending to infra and key manufacturing sectors also requires project appraisal skill with domain knowledge of the industry. In the past, the banks have underpriced the credit risk or not focused on risk-adjusted returns. Bringing professionals to run the show with a quality board at the top should be given a priority. A DFI needs people from areas like risk management, treasury, corporate finance, credit, and people with industry experience. The real issue actually is of governance, as seen from many fraud that have happened, especially in the power sector. Finally, the government should encourage a culture of innovation. Takeout finance is an ideal way to manage asset liability management, as the loan should transfer from DFI once the financial closure is achieved to banks. Clearly, the need of the hour is to create an enabling environment for a DFI to succeed than just creating another institution and leaving it to the market forces.